Entrepreneurs Channel TV, creating a platform of expression for every woman.
You are welcome again to today's edition of The Figures. The Figures on your favorite station, Entrepreneurs Channel TV, African first gender-based television. The Figure is a program that takes care of the plus and the minus in your business. Simply, bookkeeping and business management skill for entrepreneur. In today's episode, we shall be looking into bookkeeping. What do you mean by bookkeeping? Most micro and small scale entrepreneurs do not write down how much money comes in and goes out of their business. They keep everything in their head. As a result, they do not actually know how much money they are earning, how much they buy and sell on credit, how they could improve their business. Terminology. Accounting words every business owner should know. Like any technical discipline, accounting can be demystified by learning the secret language. Learn these essential accounting terms and master the business finance. Accounting in every business. Money comes in and money goes out. Accounting is nothing more than tracking the when, the who, and the how much of money flowing through your business, and then report it. It is that simple. You don't have to be afraid. Let me take it again. Accounting in every business is about money comes in, money goes out. Accounting is nothing more than tracking the when, tracking the who, and tracking the how much of money flowing through your business, and then report it. It is so simple. Now let's go on. Checkbook. Let me start with checkbook. I want to tell you that if you can keep these following books, you will be able to monitor your business financially. Checkbook is a document from your banker. When you go and open an account with a bank, a checkbook is given to you. A checkbook is a document you issue to collect your deposit from bank. It's an authorization document, authorizing document, authorizing your banker to pay you or the drawee a sum of amount. It include dates, it include amount, and it include the drawee and your signature. How would this checkbook help you? If you can cultivate the habit of making every payment through checkbook, this checkbook is a supporting document that along the line, if you forget what you have bought with money, the check stop. When you give checkbook, there will be the duplicate, the counterfoil by the side. If I say, for example, Wire and Cable Nigeria Limited, 5,000, I put date 10th July 2018. Wire and Cable is the one receiving the money, is the who. Then for what? for electronics or for wire or for the service wiring. When? 10 September 2018. Now amount 5,000. Along the line, you want to really know how much you spend for the month. Don't forget, at this junction you don't have any other document. You only issue that check to that wire and cable. From your check stub, the duplicate of the check you issue, that is always at the left side of the checkbook, you can always go back. You will see who collects. You will see when did he collect. You will see how much did he collect. And this is what we call accounting. Tracking your expenses. For what did he collect? For electronics. This is accounting. And at the end of the month, if you don't have a cash book, I will still talk about the cash book. If it is only the checkbook and your bank teller that you keep, if you can be so disciplined, I bet it with you are going places. Accounts can be made. Your profit and loss account can be drawn from your checkbook and your bank teller. They are source documents. So that is checkbook. An entrepreneur has to be disciplined to make sure every kobo, every dollar is paid through checkbook. You want to ask me, if I want to make an expenditure of $10 or 1 naira in Nigeria currency, do I still have to issue check to pay such? It's about discipline. You can list, you can sum up one, two, three, 4 things you want to buy. I want to make my clothes, or let's talk daily business now. A bakery now that produces bread. We want to buy yeast, $10. You want to buy flour, $2. You want to buy baking powder, $2. That is $12. Instead of issuing the check in pieces like that will now make check to be expensive. Another expenditure on its own of eyesight. Put all these expenses together. List it at the check stub. All what you want to buy. Give it the name, whether it is your cashier that will go and withdraw the money. Put the name of your cashier as the drawee. Then by the check stub, the name of the drawee is there. List all what you buy or you intend buying with the money. Now when you are now summing up at the end of the month or end of the year, you will discover that you have helped yourself. The memory of what you bought is kept. The lists are kept. You'll be able to track how your money gets out. You'll be able to track it. For what? What account? What did I use this $12 for? By going back to your check stub, you will see the detail. That's checkbook for you. Now, bank teller. Bank teller is evidence of all your deposits. Each time you go to the bank to deposit money, you fill the bank teller. On the bank teller, you have amounts paid both in figure and in words, the name of the depositor, and the signature of the depositor. Now, let's assume you are the one that deposits. You deposit money to your bank. You deposit $50. It's documented. Then, when you deposit this money with the date, or it is even your customer that want to buy bread from your factory, from your bakery, they go and deposit money. They deposit the money in the bank and come and give you the teller. Come and show you the teller. And now with the teller, you issue receipts. You have helped yourself. You minimize keeping cash with you. When cash is not stupidly kept with you, you have helped your business. When you only keep what we call like petty cash, money to run your day-to-day activities, you want to buy who some things, you want to buy what you need for your operation in a larger quantity, you issue check. When your customer pay, you deposit into the bank. You discipline yourself that money from your sales is not tampered with at all. It goes straight to the bank. Daily sales goes to the bank, both cash and check. If you are paid check, if you are paid cash, make sure you lodge them into your bank. You don't take out of it. When you take out of it, there is leakages already, and when there is leakages, we have problem in summing up, in balancing your account. You will just discover, you'll be asking yourself, I miss money. Meanwhile, in real, you might have missed money, you might have spent the money along the line. But when you so discipline yourself that no, every kobo, every dollar must go to the bank before spending. When it is in the bank, then we now use checkbook to control what we buy, to document what we buy with the money. That's bank teller. Then receipt booklet. You make sure receipt is given to every sales made. You so much discipline yourself. You know, when you have it as a structure, your staff will definitely follow your structure. It is an internal control of a business organization that every money paid is receipted. Every money collected from customer is receipted. With this, it will help you to really have the actual sales, the actual income, the actual cash sales for the day or for the month, the actual income that comes in per day or per month, or as you want it. That is receipt booklet. It always have the original and duplicate. When customer come, you write it, the name of the customer, the date will be there, amount paid will be there, and your signature and the signature of that customer. At the end of the day or at the end of the month, when you want to know how much has come in, your receipt booklet will definitely help you to really have the actual amount of money that really came in. That is receipt booklet. We have petty cash book too. Petty cash book is a book where transactions that are not really in a big sum are recorded. What do I mean? Imagine in a company or business organization where you buy your awesome things from the sum of $10,000 to unlimited like that, goes up like that. Now, when you now want to buy, say $10,000, you now have reason to buy something of $2. $10,000 will be automatically issued with check. You'll be paid with check. But like that $1, like that $10 is still something like petty, not really, it look insignificant but still matter. Without it, you may still not run your company. Those ones go to petty cash book. Those ones are met with the money, the IOU, the money that are in with the accountants for daily runs, for weekly runs. You can't be going to bank every time. You withdraw particular sum of money with your check, and you can write for petty cash, for petty expenses. Now your petty cash give account of that money you withdraw that you call petty cash, that you tag petty cash. It is this petty cash book that will give you analysis of this money you withdraw for petty cash. We have payment voucher. Payment voucher is an authorized document authorizing the officer in charge to spend money. It is an internal control put in place so that your accountant just don't spend money anyhow. Even you don't spend money anyhow. You document to make sure there's a process. We need to raise check for so amount. On your payment voucher, you will have What do you want to use the money for there? The particulars. You will have the date that you want to use that money there. You will have who authorizes that expenses. You will have it there. And you will have approval there too. This payment voucher is in operation where you have partnership, where you have corporate businesses, large businesses, so that to checkmate money movement. That is payment voucher. We have bank statements. When you keep your cash in the bank, when you lodge your cash in the bank, and when you withdraw, that transaction of your in and out of your money is called bank statement. It includes lodgement, that means the money that you put in the bank. It includes check issues, check payments. It includes discount you receive on your account. It includes the interest on your account. It includes bank charges and all sorts of, and of course slated for per month. You have it per month. That is bank statement. In a normal situation, your bank statement is supposed to have a balance figure. That means by the time you remove payment from the lodgement, you're supposed to have a balance there. But sometimes your payment is more than your withdrawal. Where your lodgement is more than your withdrawal, that means you have enough cash, excess of cash above expenses. Where you have your withdrawal more than your lodgement, then you have excess of payment above receipt. And there's what we call bank reconciliation. Bank reconciliation, where you reconcile your bank statement with your cash book and your teller. Don't forget, your own cash book and your teller is with you. Meanwhile, the bank is sending you a statement telling you this is how your financial transaction with them look like. So sometimes you will see figure from your checkbook that is not in your bank statement. When that thing happen, that means there are some unpresented check. You have issued check, but that customer have not presented it to the bank. To you, the money have gone out, but to the bank has not paid the money. That is unpresented check. Then there are some interests. There are some bank interests that until when you see the bank statement, you will not know the amount. Like when the bank transfers some figure, some money on your behalf, you pay for the service. These are called bank charges. There's also what we call bank interest. For keeping your money with that bank, it will have spelled out, the bank has their policies, how they deduct this money. And when you keep your money, interest is given you on your deposit. We have again what we call sales book. Sales book is a record of your sales transaction. You know, sales can be on credit and sales can be on cash. When you make your sales, it can be your debtors, because if they are not paying cash, then that is debtors. And if they are paying cash, that is cash sales. And if it is through check, that is bank. So we have sales book. It tells you how much sales you make per day, per week, or per month. It tells you when those sales are made. It gives you record of sales return. After you have sold the goods, customer may return the goods and say it's damaged. Customer may return the goods if there is provision for it in your policy that he doesn't want such quantity again. So we call it sales return. That is sales book. Inside sales book too, you have discount. A sales may be $50, and you decide to give discount on that sales. You will have sales discount. That means if it is $50, you give 5. If you want to give 10% of $50, that is $5, if I'm right, so that the discount reduces the total amount of sales.
Entrepreneurs Channel TV, creating a platform of expression for every woman.